What do you think he took before that? Another 10%, another 10%, another 10%, and 50% off that. So can I say Mota Bhai is made good money? Mota Bhai has made good money. Do you know that 3,900 crores is basically $500 million that goes into his bank account every year? $500 million. And this is not including his share price going up. His share price is still going up. This is bonus. Super, wonderful, but it doesn't end here. Boss, it doesn't end here. Let me teach you more. These are investors who are investing from outside of India, not from India, outside, dollars, They might be growth funds from Europe. As you see, there's a Euro-Pacific growth fund. Government of Singapore has 1.5% in Reliance. There might be so many hedge funds from US investing in Reliance, right? Now let's assume how much did Mukesh Ambani make for these guys in dividends. So the total FII holding is 22%. So now if I go back here and do 7,900 into 22%, Mukesh Ambani made 1,738 crores bonus for all the people who have invested in him from outside of India. You've seen this news. Dubai is investing heavily into Adani. Dubai is investing, Abu Dhabi is investing into Reliance. All this money goes back to them, out of the country. Basically, the rich have become richer. Do you agree now? Now you understand the game? Rich have become richer concept? Yeah? Okay. Till now we understood. What is the next thing? There is something called DIIs. Do you know what the full form of DIIs are? They are called domestic institutional investors. These are our guys. Apna lo. These are Indians. Okay, these are your SBI mutual funds, your HDFC mutual funds, your Axis mutual funds, your LIC mutual funds. But who puts money into the mutual funds? By the way, who puts money into the mutual funds? We only put money into the mutual funds. So they take our money and put it back into Reliance. Yeah? So they invest like that. They invest it for us. Fine. No problem. Because this is money inside India. Money is coming back to India. So how much did Mukesh Ambani make for all the mutual funds in India? Another 17%. Okay? So 7,900 into 17% is 1,343 crores made for all the mutual funds in India. Good or bad? Good or bad? That's awesome. That's awesome. Because this money makes the mutual funds value go up more. Okay, fine. Finally, we have something called public. Do you see public here right at the end? Do you know who public are? Public are people like me and you. Okay? Buying Reliance shares directly. We hold only 10% of Reliance. Only 10%. This is out of 7 votes. Only 10% came to Aam Aadmi. People like me and you directly in our pockets. Do you know when Reliance share falls down, who cries the most? Who cries the most when Reliance share falls down? People like me and you. Guilty. We only cry the most. But you know that we hold the smallest amount of stake in Reliance. In fact, if Reliance falls down, Mukesh Ambani, FIIs and DIIs have to cry more because they own 90% of the business. We own only 10%, chindi amount. So small. But we cry the most. Do you agree to this? Now I came to the part of tax. Remember I spoke to you about tax? That does Mukesh Ambani pay tax on this? Is he mad to pay tax? Do rich people pay tax? No, they don't pay tax. What do? They take this money into a trust. You know what a trust is? They take money into a trust, holding companies, and then they divide the money. Okay? Very good information. Do you guys like this information? By the way, the website that has all this information, guys, the website that has all this information, I'll give it to you. It's called Screener. Let me give you this information. It's called Screener. It is a free website. Okay? Just go to this. It's a free website. Understood? Got it? Very interesting. Amazing. Now, let me show you our old example. Do you remember TCS? TCS, you remember? Yeah? Now, look at something that is very funny. I'll show you something that's very funny. TCS last year, look at last year's data, 2023 data, they had 42,000 crore net profit. And what is the dividend payout ratio last year? What was the dividend payout ratio? 100%. 100% is dividend payout ratio. That's too much, right? That means 42,000 crores of dividend. That's madness. Yeah? Correct? Agree or not? This is dividend, money going out of the company. Now let's understand who owns this who owns Tata Consultancy Services, how much percentage? That is your next question. Let's look at it. So the promoters last year, Tata Sons, by the way, Tata Sons Holding Company, they had 72% stake. Okay, 12% was owned by FIIs and 10% was owned by DIIs, and only 5% even today is owned by people like me and you. But that is not the question. The question is 72% of the previous amount, which is 42,000 crores. Let's understand what is that. 42,000 crores into 72%. 30,000 crores went back to Tata. Do you know why they did this? Does anyone know why they did this, or should I give you a nice story? Little off topic, but I can give you a nice story about this. You want to know why? Should I give you a nice story about this? Okay. Listen to this very carefully. Okay? Listen to this very carefully. Basically what happened is, listen to this graph very carefully. Last year, Tata Consultancy Services, that was making a lot of money, gave 32,000 crores to Tata Holding Company. Now, Tata Sons Holding Company is a tax-free entity. It is called Tata Trust, Tata Sun Trust. Okay, it is a tax-free entity. So, complete 32,000 crores went back to Tata Holding Company. Now, what did Tata do with this 32,000 crores? What they said is, guys, TCS is making so much money. We're taking 32,000 crores into our bank account and we are going to redistribute it to all our businesses that need money. That means I'm going to give it to Taj Hotels. I'm going to give money to Tata Motors. I'm going to give money to Tata Power. I'm going to give money to Tata Consumer, and I'm going to give money to Trend. But why did they do this? So that Taj Hotels can expand their business and grow more Taj Hotels. Tata Motors can make more electric vehicles and make money. Tata Power can start more charging stations. Tata Consumer Products can open more Starbucks, and Trend can open more Zudio stores. But if Tata did not do this, then all of these guys would have to go to the bank, take money from the bank and pay 13-14% interest. So by Tata taking money from one of their own companies, tax-free, and giving it to all their smaller companies, that was a master stroke. And because of that, last year, IHCL, Tata Motors, Tata Power, Tata Consumer and Zudio Trend have all gone up by 40-50%. All the shares have gone up. Why? Because suddenly they got extra money that they did not pay any interest for. In fact, some of them, like Tata Motors, paid their loan early also and closed some loans so that the interest is not there. Isn't that amazing? How's the story? Good or bad? By the way, this is real life. It's not story. It's actually really what happened. But that is why Tata was doing so well because of this. Crazy? New information you're learning today? Nice new information you learned today? Yeah? Okay. Cool. Let's do one thing. Okay? Profit and loss statement, you guys are experts now, so I don't need to say anything. Balance sheet, dividend payout ratio, all of you guys know. Awesome. Congrats. Can we now go to balance sheet? Can we now go to balance sheet? Yeah? Can we go to balance sheet? Let's learn, because you need to learn everything, right? Okay. Let's come to balance sheet now. Now, in balance sheet, listen to me very carefully. We'll finish balance sheet and we'll take a small 2-minute break. Is that okay? We'll finish balance sheet and take a small 2-minute break. But I'm sure you're enjoying now, right? You're enjoying till now because it's crazy information. And it's so easy for you to digest. Okay, what is balance sheet? In balance sheet, we need to learn only two things. Two important things we have to learn, guys. What is the two important things? One is reserves. How much money is in the company bank account? And the second is borrowings or loan. How much loan I have in my bank account. Now, what is the amount I told you last year that I have in my balance sheet? How much money am I saving last year? How much money did I put back into my company bank account? Very good, 11.25 crores, right? 11.25 crores is the amount of money I put last time back into my bank account. Wonderful. And how much loan did I have last year, guys? How much loan did I have last year? Completely zero. Very good. Now, what I'm going to do is, let's come to year 2. I'm telling you guys that, guys, in year 2, I have 150 crores of sales. Is it good or bad? Year 2, I have grown my sales by 50%. Is it good or bad, guys? Yeah, all the smart people now have become smarter. They're saying, boss, first tell us what the expense is. Good one, good catch. Very good catch. Okay. Okay, I'm going to say that my expense is 105 crores. Okay, I'm going to say my expense is 105. That means my operating profit becomes 150 minus 105, 45 crores. And my operating profit margin is 45 divided by 30%. Till now, okay? Till now, okay? We're all agreeing to this? Wonderful? Okay. Now I'm going to tell you guys something. So guys, listen. Last year, the reason why I grew from 100 to 150 crores is because at the end of last year, I thought I should take a loan. Okay? I thought I should take a loan to make a new manufacturing plant in the market. Now, I took a loan of 50 crores. Let me come back to my balance sheet. And I'm saying this year I took a loan of 50 crores. Okay? And the bank gave me an interest rate of, let's say, 15% to make it easy. So basically, every year I have to pay 7.5 crores of interest. Only interest is 7.5 crores. Okay? So what is my interest now? 7.5. Yes? So what is my profit before tax? 45 minus 7.5. And on this, I have to pay 25% tax. Okay, 9.4. So I'm just going to do minus. Basically, it comes to 28 crores. Okay? 28 crores is my net profit. Is this good or bad now compared to last year to this year? Last year to this year, it is good. No problem at all. Okay. Now I'm going to say the same thing. I'm going to keep 50% in my company bank account and my dividend payout ratio is going to be 50% again. Cool? Correct? The tax I've paid 25% only, guys. Tax is 25% of 37.5. Okay? So what is the amount that is going back into my company bank account? Out of 28 crores, half of it is 14 crores. Okay? So 14 crores plus what did I have last year? 11 crores. So basically I have 25 crores in my bank account and I have 50 crores worth of loan. Okay? This is the understanding of our company today. In year 2, 25 crores is my reserves, which is my money in the bank account, and 50 crores is my loan. Agreed till here? Now, what happens? Listen to me very carefully. What happens if tomorrow the government of India comes and says, Shashank, you cannot make this glass bottle anymore. It is not allowed. We are moving to only aluminum bottles. What happens to my company? I have made a new manufacturing plant to make a glass manufacturing company. Now, what will happen to my company? First thing is first, I have just taken money from SBI. Let's assume this is SBI. I took 50 crores from SBI to set up a new manufacturing plant. Maybe this happened. Maybe recession happened. Maybe tomorrow I could not build the plant fast enough. Right? Now, can I go to SBI bank and be like, bro, SBI, listen to me. I can't pay this year because, government of India banned my glass bottles. So can you tell me that I cannot pay loan anymore? Do you think SBI will be like, Shashank, you're our friend only, don't pay. When money comes, you pay us. Will SBI do that to me? Will SBI come and tell me, don't pay loan? Chalo, maaf, we'll do it later. No, right? He's not my father or brother or grandfather's company. SBI is not there, right? So what will SBI say? Now I have two options. I'm like, shit, SBI is saying, please give me the money. I have two options. First is the easy option. What is the easy option? Take a flight, first class, business class flight to UK and run away and stay there and only tweet on holidays of SBI. That is the first option. Very easy to do that. Kal I will take a flight and go, nobody will know. I am already in UK and I am texting on SBI holidays, Happy Ugadi. That is my first option. But I am not that. I am a good citizen of India because I love paying taxes, right? So now what I can do, I will be like, okay, let me think about this. So I'll be like, SBI, come here. Listen to me. 25 crores I have in my bank account. You take it. Full money what I have, you take it and go. SBI is like, okay, we will take your full money But another 25 crores, what will you do? You still don't have 25 crores. We're still stuck. So then SBI will be like, this new manufacturing plant you bought, right? You just bought a new manufacturing plant. We are locking it up. We are seizing that new one, and we will liquidate and take that 25 crores as well. And we will lock down your facility. If they lock down my facility, what will happen? My reserves have gone to zero, my loans have gone to zero, and my revenue from 150 will come down to 75. And I am finished. Yes or no? Stock will go down. Now, why did all of this happen? Why did all of this happen? Did this happen because I was being a little aggressive in life? Did this happen because I was being a little aggressive in life by taking a 50 crore loan? Do you believe that? What if I had not taken a 50 crore loan? And let's assume, what if I had taken only a 25 crore loan? And I had 25 crores here. Would this be okay? Would this be still okay? It's not great, but it's okay because my existing manufacturing plant will not go down. I can make revenues and grow back. Okay, instead of 25 crores, what if I had just taken 15 crores? What if I had taken 15 crores? I'm completely fine. No problem at all. Right? So very good. You have just learned a new formula called debt to equity ratio. It is also known as a solvency ratio. Debt to equity ratio basically says what is Shashank's debt to his equity. So what is my debt? 50. What is my equity or my money? 25. So if I check my debt to equity ratio, it comes to 2. Anything above 1 is considered bad. Anything above 1 is considered bad. Anything above 1 means I have to refinance that loan, I have to sell my plant machinery, and it becomes a big problem for my life. We all understood this now? So if my debt was 25 crores, I'm okay. And if it was 15 crores, I am much, much better, peaceful in life. And even the shareholders, which are you guys, will be peaceful. Yes? Or else I will run off to UK and make my money and you will be like, Shashank, my shares are stuck. What did you do? Why did you do this? Do you all agree to this statement? Yes or no? Correct? So debt to equity ratio needs to be less than 1. Okay? Now that was what your new learning was in the balance sheet. Now let's understand with examples. As I said, we should always do examples, right? I'm just doing examples now. This is the balance sheet of TCS. What is TCS's reserves? TCS's reserves is 90,000 crores. What is the borrowings of TCS? 8,000 crores. Is that good or bad? Is that good or bad? Nothing. That is amazing. There's no loan only. 8,000 crores. TCS is throw it on the bank and say, get lost. Don't talk to me right now. Okay? Okay. Let's understand another company. Look at Adani Enterprises. Now, there is a shortcut to do this, by the way. There is a shortcut to do this. You don't have to keep going to the reserves and borrowings. When I told you go to screener and check screener, you can go to screener and there is something called add ratio on table. You can see this, right? Go to that add ratio on table and just type debt to equity. It will show up for you completely free. Now, automatically when I click on Adani Enterprises, you will see debt to equity ratio is 1.67. Is this good or bad?
Bad.
1.67. Bad? 100% bad. Okay, let me give you another example. What about Mahindra and Mahindra? 1.61. Bad. Look at Tata Motors balance sheet. Tata Motors balance sheet. One second. Where did it go? Yeah, Tata Motors balance sheet. 84,000 reserves and 1,07,000 borrowings. Almost 1:1. Almost 1:1. But I want you to observe something. Can you go to last year, March 2023, see the reserves and borrowings. 44,000 crores reserves and 1,34,000 crore borrowing last year. Boss, that is madness. That is madness. It was 3 times debt to equity ratio. Remember when I told you one Tata story? Something happened. Tata gave money to Tata Motors. Immediately see the impact next year. The loan from 1,34,000 has gone down to 107. And the reserves of Tata Motors has gone from 44 to 84. Can you see that difference? Now you understood how money flows in the market. Now you understood how it went from 44 to 84 and loan went from 134 to 107. When Tata Technologies IPO came out, Tata Motors made 10,000 crores from that IPO because Tata Motors had stake in that company. It made 10,000 crores which it used to clear the loan. Wonderful? Wonderful? Now you know how real life examples are made. Now you know how real life examples are made. Amazing. Okay. Can we take a quick 30-second break before I go to the next exciting part, which is called valuations. Now, this is the most amazing part. See, now you have become an expert in profit and loss statement. You have become an expert in balance sheet. Now we are going to become an expert in the valuation metrics. And we are going to have fun. In the same way we will learn. Same way we will learn. Okay? Awesome. So I'll just have a sip of water and coffee and then we'll start. Just a 30-40 second break. Just have some water. But by the way, for all the people who are here, how are you enjoying it till now? How are you enjoying it till now? Are you enjoying it? Are you loving it? It's a very different way of learning. See, I can easily go and confuse the shit out of you and just show everything and be like, this is this ratio, this is that ratio. Nothing you will understand. The way I'm teaching you today, you need to learn it once and then you don't have to learn ever again. Okay, that is how basically I teach my students. I love teaching. That is why I'm very passionate about teaching and I teach a lot of my students very similar way. But I teach them more slightly advanced stuff also about what stocks to buy and what stocks are there and which sector is good, which sector is bad. All of that we do. But this is how you start. Okay. Okay. Let's go to the next one. Chalo. Now we go to valuation. Very interesting. Now, you remember this valuation when I said 70-30? You remember this valuation when I said 70-30? Bhavin is saying teach P ratio. Bhai, I'm coming to it. I'm not running away. I'm going to teach you everything, boss. Relax karo, Bhavin. You remember 70-30? Now, let's assume, okay? Let me remove all this. Let's assume that my company, which is Shashank Gudappa company, I have not told you how much 70% of what and 30% of what. I just said 70-30. I didn't say 70% of what. So can I assume for example purpose that this Shashank Gudappa water bottle company, this one, okay, has a total of 10 crore shares? Can I assume that? 10 crore shares? Yes or no? Just assuming, assumption. I have made it out of thin air. 10 crore shares. Because easy for calculation. So how much do I own? 7 crores worth of shares and you own 3 crores worth of shares. Simple logic. Okay? Why am I showing you this? Because this is important. Okay, so the total shares of the company are 10 crores. Okay, very good. So I'm coming here. What is the total shares of the company? 10 crores. Okay. How much profit did I make in the first year? How much net profit did I make in the first year? 22.5 crores. Okay. Now, my total shares are 10 crores. My total net profit was 22.5 crores. If I ask you the question, how do I calculate what is the profit per share? What will I do? I want to calculate profit per share. So what will I do? I will do 22.5, which is my profit, and I will divide it by the total number of shares I have. Okay? When I did that, it comes to 22.5 or 2.25. Okay, I've rounded it off to 3, but it's 2.25. Correct? Did we understand this? How I got 2.25? Very simple, basic mathematics. Total shares 10 crores. My profit was 22.5 crores. So my question to you was, what is my profit per share? Nothing. Divide profit by total number of shares. Comes to 2.25. By the way, this 2.25 is nothing but EPS. Remember somebody was asking me, Shashank, what is EPS? What is the full form of EPS? What is the full form of EPS? Earnings per share. Technically, earnings per share is nothing but profit per share. Okay, what is the formula for profit per share? It is total profit. Sorry, remove this. It is profit divided by total shares. That's all. It's basically total profit divided by total shares. That's it. Till now, did we understand 2.25? How we got? We understood EPS. We understood 2.25. We all agree? Okay. Now I want to ask you guys a question. Listen to me very carefully. Now all of you guys are shareholders of my company. Do we agree to that? All of you guys are shareholders of my company. 30% you guys own. And I am telling you that Shashank Udupa's company, which is this water bottle company, has made 2.25 profit per shareholder. Per share, whatever you own, I am making 2.25 rupees. Now I'm saying, guys, I want to sell some shares to you guys. I want to sell some of my shares to you guys. Will you guys buy it? Will you guys buy it? If I sell some shares, will you guys buy it? Okay. I am asking a share price of 100 rupees. Will you guys pay me 100 rupees to buy my share? Everyone saying no. Arshit, Sarthak, everyone saying no, 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 no. Okay, only one or two guys are saying yes. Okay, so almost all saying no, because why will I pay you so much? Only it's 2.5 rupees you're making and you're saying buy it at 100. Okay, what about 50 rupees, guys? 25 times more I'm asking. Still some people are saying, no, it's still overvalued, and very few people are saying yes. Okay, mostly no. Okay, guys, what about 30 rupees? 10 times more. 10 times more. Okay, I'm saying half. Okay, half. Okay, chalo, let me be very clear. 2.3 rupees. 2.5 rupees, chalo. Are you guys saying yes or no? Everyone said yes. Guys, can I tell you something? Very smart, by the way. When I told you that I'm making 2.3 crores per year. By the way, next year also I made profit, right? Remember, I made 28 crores next year. So my next year's profit per share or EPS was 2.8 next year, right? But you all said that, Shashank, we will not pay you 100 because 2.25 we are not going to pay. No chance. I said, okay, fine. No problem. Then 50 you said no. 30, half people were ready, half people were saying no. And 2.5, everyone said yes. Do we agree? 2.25, everyone said yes. Clear? Now, when I asked you 100 rupees, how much is 100 rupees of 2.25? How much is 100 rupees of 2.25? 44 times? 44 times? Yes? Yes or no? I'm waiting for you guys to tell me whether it's yes or no. Okay? 44 times. So you don't want to give me 44 times. Okay, fine. When I asked you for 50, okay, 50 divided by this, 22 times you said no. Correct? You also said no for this. When I asked you for 10 times, you said no. And when I asked you for, let me make this shorter. Okay? When I asked you for one time, okay, when I asked you for one time, all of you guys said yes. Do we agree to this? All of you guys said when I asked you for one time. Do we agree to this, yes or no? All are clear about this math, how I got this math? All of you guys are clear? Yeah? All of you guys are clear about this? Very good, guys. All of you guys just now learned what PE ratio is. This is P ratio. This was P ratio. Congratulations. This is P ratio. You want me to explain? You want me to explain how I got this? You already knew it, by the way. You already knew it. You just need little help in understanding, right? Okay, chalo, let me come back to it. This you understood how we got it. Let me make it completely like this. Okay? This you understood how we got it. P ratio, 44 times. So basically when I told you that guys pay me 44 times more than my EPS, you said no. When I told you pay me 22 times more than my EPS, you said no. When I told you pay me 30 times more than my EPS, you said no. And when I asked you one time more than my EPS, you said yes. Okay? What is P ratio's formula? Very interesting. P ratio is nothing but price divided by, which is nothing but price or share price, which is the price I asked you to buy my share, okay, divided by profit per share. That's it. Or EPS. That's it. This was the formula of P ratio for all the people who used to get confused with P ratio. What is PE? It is called price to earnings ratio. It is price to earnings ratio. As the name suggests, it's price to earnings ratio. So P ratio, why do people talk about P ratio so much? Because P ratio is a measure of understanding how many times am I paying more than the profit per share. Am I paying 44 times more? Am I paying 22 times more? Am I paying 13 times more? Or am I paying 1 time more? Understood? Crazy? Crazy? Now let's come to the ideal range of P ratio. Yes, very good question. What is a good P ratio? P ratio can be anything, right? But what is a good P ratio? We need to understand. So ideally what you need to do is, let me show you. Okay. Look at Titan. Titan is trading at a P ratio of 86. Do you think it's overvalued or undervalued? Now, the best way to compare 86, there is something called industry PE ratio. Look at this, industry PE ratio. That means all the other gold players in the market are trading at 24 average and Titan is trading at 86. Now we agree that Titan is a great company. It is one of the biggest company. So if the industry average is 24, shouldn't Titan be maybe 27, 28 because it is a big company, little premium it can take, or chalo 30. But 86, isn't that a bit too much? 86 times earning. Yeah, debt to equity ratio is also high. Let me take you another example. Okay. What about Reliance Industries? Reliance Industries is trading at a stock PE of 28. Okay. Is that good or is that bad? 28, we don't know. We have to find out, right? Industry PE, we have to see. There is another easy way. There's a hack. Should I tell you a hack to find out whether the P ratio is good or bad? Should I give you the hack? Yeah? Go to screener. Okay, let me see if I can do this for you. Go to screener. Okay, over here, go to Reliance. Quickly go down here and you will see the stock price. Correct? This is the stock price. When you go to the stock price and you click on P ratio and you click on 5-year chart. Actually, you can even go to 10-year chart or you can go to max chart. Now, what this basically says, that in the last 20 years or whenever Reliance has been there since 2006 to 2024, every time the P ratio went to 30, Reliance fell down after that. It did it once in 2008, it did it once in 2020, and then it crashed after that. And now it's going above. In fact, the median PE, look at this, median PE is 18.3. The median PE is 18.3. That means over a period of time, average Reliance shares has been at 18.3. So if I'm paying 30 rupees today, am I overpaying or underpaying right now? And this is not me giving you the P ratio. This is Reliance itself giving you a P ratio. I'm overpaying right now. And every time Reliance has gone below the median PE, can you believe after the 2008 crash, Reliance was trading at 12 PE. Blind buy. Close your eyes and buy. 2015 Reliance was trading at 12 PE. From 12 PE, it has gone up to 28 PE, and that is what you will see in the stock price. If I go to the stock price and do last 5 years or last max chart, you will see from 2015 how it's gone up from 500 rupees to 3,000 rupees. Crazy? Crazy or not? And if you see the industry PE here, if I do industry PE and click on it, it's 8.18 and this guy is sitting at 28. Whew. Madness. So that not only gives you whether you're overpaying or underpaying, right? But P ratio also gives you, with the history of P ratio if you do, it also gives you an understanding of when to enter and when to exit a stock. Mainly when to enter. Whether I'm entering at an overpriced situation or an underpriced situation. Correct? Now, one more. Last part of today. Let's understand one more thing. What is the share price? What is my share price today? What did you guys give my share price today? You all said yes to one PE ratio. 1 PE ratio. So sad. 1 PE ratio. People are giving 20 times, 25 times, and you've given me 1. No premium for Shashank Gudappa. Okay, fine. 2.25. Correct? Yes or no? This was the share price you all said yes to. Now, tomorrow, let's assume that Ratan Tata gives me a phone call. It's possible, guys. I mean, he can give me a phone call, right? Ratan Tata gave me a phone call and said, Shashank, I wanted to buy Bisleri, but Bisleri guy said, no, I believe you have a water bottle company. I want to buy your entire company. 100% of your company I want to buy. I said, wow, Ratan, that is great stuff, man. You can definitely buy my entire company. So Ratan Tata says, okay, what is the worth of your company? What is your company's valuation? So I'm like, see, I'll tell you, my share price is 2.25 crores. And then Ratan Tata says, okay, cool, 2.25 rupees. My share price is 2.25 rupees. Ratan Tata basically says, how many shares do you have that I have to buy? Oh, I said, okay, cool. So my total shares in the company, I have 10 crores. So Ratan says, oh, that means your valuation of your company, if I have to buy your whole company, I have to basically pay 2.25 rupees to your 10 crore shareholders, 10 crore shares that you have. So technically my entire company's valuation is 22.25 crores. Is that correct? So Ratan Tata, if he wants to buy my company today, it is going to be worth 22.5 crores. Simple. 22.5 crores is what Ratan Tata has to pay. That means he has to pay 2.25 rupees for all the 10 crore shareholders. 10 crore shares that are there. Out of that, 7 crores is mine, 3 crores is yours. So you get 2.25 into 3 crores. I get 2.25 into 7 crores. And this is the valuation. Now, do you know what this valuation is also called in the market? Do you know what this is called? Yeah? This is called market cap or market capitalization, etc., etc. But let's keep it simple as market cap. Market cap is basically the valuation of a company. Okay, this determines whether a company is big or small. If somebody wants to buy my company, they have to pay 22.5 crores. Remember, if you guys had given me little more, if you had given me 100 rupees, 44 P ratio, then he would be paying a lot of money right now. Okay, but you guys only gave me 2.25 rupees. So because you guys gave me a lower valuation, my stock price, my entire valuation of the company is also low. Isn't that very sad, guys? Isn't that very sad? Yeah? Yeah, that is life. But this is basically market capitalization. Okay, now can I explain something to you guys? Now we've understood all of this. You've become experts in profit and loss statement, balance sheet, valuation, dividends, P ratio, and market cap. Now, I want to ask you a question. Remember in the start of this masterclass, I told you that I will show you some companies. Now you have to tell me if it's good or bad. Can we start doing that? Can we start doing that?
Yes.
Now, is there a way? We all agree that TCS is a good company. Me and you agree that if I go back and I show you TCS's shareholder profit and loss statement, we all agree TCS is a good company because it went up, everything is going up, consistently growing from time to time. Yes. So if I find a company that has TCS DNA, can I find more companies that have TCS DNA? Right? Okay. So, but Shashank, there is one problem with this. What is the problem? The problem is there are almost 5,000, 6,000 companies in the stock market. How will you sit and find a good company? Is there a shortcut? Is there a hack? Answer is yes. Answer is yes. Okay. Come back to screener. Okay. Click on screens. And here go to click on new screen. Remember what all we learned? Okay. We learned that sales of a good company should be growing. Operating profit margin should be growing. Debt to equity ratio should be less than, you guys have to tell me, debt to equity ratio should be less than 1. So you know these rules and regulations, right? So what I've done for you to make your life easier in this Excel sheet, if you go down, I have automatically put the entire screener for you ready made to copy paste. Copy this, go to screener, click on screens, click on create new screens, and then paste it here and run this query. You will automatically get a lot of companies. Oh, one sec. What is this? Oh, I have to remove this. Sorry. Don't copy the screener part, obviously. Just do this. And suddenly, if I open this, see, you will get so many. You will get 249 companies. And it is going across 1, 2, 3, 4, 5 pages. Okay? But let's not do this. It will get complicated. Okay? Let's do one thing. I'll show you now examples of companies You guys tell me if it's good or bad. I am not going to tell. You have to tell me good or bad. Okay? Are we ready? Are we ready to do the learning part? Now you guys know everything. Okay? Awesome. This is Maruti Suzuki. This is Maruti Suzuki. Is the P ratio overvalued or undervalued? Is the PE ratio overvalued or undervalued? Think properly. It is fine. It is fairly valued. That is either overvalued, undervalued, or fairly valued. Okay, it is fairly valued because industry P is also 30. What is the debt to equity ratio of this company? Zero. Zero debt to equity ratio. That is great. But wait, we have to find what is the share price look like. Okay. So let's go to the share price. This is the 5-year share price. In the last 5 years, the stock price is growing or going down? Is it going up or going down?
Growing.
Going up?
Up.
Okay. If the stock price is going up, that means the last 5 years revenue has to be going up. Yes or no? Let's look at the last 5 years revenue. 2019. Okay. 86, 75, 70, 88. Ignore COVID year. 88, 117, 141. What about the profit? 7, 3, 5, 6, 5, 7, 11 and 18. Good or bad?
Good.
Last 5 years, good or bad? Very good. What about EPS? EPS went from 187 to 429. Good or bad? Very good. Now, what about return ratios? This stock, if you had invested in this stock, over 10 years, last 10 years, it has given you an average return of 19%. Remember in the start of this session, we spoke about some percentage. What did we say was a good percentage? Anything above 15, 16 is good. This company, which is Maruti Suzuki, which is one of India's largest auto players, is giving you 19% CAGR. That's mad. So is this a good company or bad company? Is this a good company or bad company? Good. We all agree. Your confidence now has gone up a little bit. You know where to look at. You know what to analyze. Yes? Your confidence has gone up? Okay, wonderful. Let me give you example number 2. Pie Industries. Okay? What is the industry PE versus stock PE? Is it overvalued or undervalued? It's good. I like it. It's fair. Okay? What is the debt to equity ratio? Very good. No debt. 0.02. Beautiful. Let's go check. Last 5 years stock price. Good or bad?
Good.
Very good. Okay. What is the last 5 years profit and loss statement? Okay. 2019 se let's check. 283345536476. Every year growth. Okay. 496, 580, 720, 1000, 1100, 1500, 2000. Okay. 410, 457, 738, 844, 121, 1230, 1682. EPS went from 33 to 110. Okay, what is the return ratio say? The return ratio in the last 10 years is 27%. Last 5 years is 26%. This is over time one of the biggest compounders that you will see in life. Is that good or is that bad? Isn't this good? Crazy? If you go to Pie Industries on Screener and check its max chart, you will see the chart is up like this. Anywhere in life, if you had invested, you would have made money. Okay? Option number 3. Okay? Fast we'll do now. Now you're a little smart. Can we go a little faster? Okay. What is the P ratio? Overvalued or undervalued? Overvalued. Okay? What is the debt to equity ratio? Not there. Okay, no problem. But industry P is overvalued. Look at the last 5 years stock price. Oof. Little weird. Last 5 years stock price is not great. Not great. That means the revenue is weird. Okay, let's look at the revenue last 5 years. Look at this. 4751 49 587186. Profit 864 1000 938 1. That means it's too fluctuating. Up and down, up and down, up and down. Yeah. So can I say this is risky? Slightly risky? Because this is an IT company. All IT companies did very well in COVID. But this guy didn't do very well in COVID. Correct? So I can say this is risky. I'm just showing you how to analyze good companies from risky companies. Okay? Now, option number 4. Have you heard of Narayana Hrudalaya company? The eyes company? Everyone's heard of Narayana Hrudalaya? It's a hospital chain like Apollo Hospitals. Okay. Undervalued or overvalued? Undervalued. Debt to equity ratio? Completely fine. Okay. Let's look at stock price. Good or bad? Very good. Okay. Let's look at the profit and loss statement. 283125 COVID year, 374550. Okay, very good. 434, 664, 987, 1152. Very good. What about the P ratio? 5, 16, 29, 38. Very good. What about the 5-year CAGR is 44%? This stock has given 44% compounded annual growth rate over the last 5 years. All the people who are saying 50% I want, 50% I want, this is giving 44%. And Narayana Hrudalaya is a very big institution, by the way. It is not a small institution. We agree to that? They've been there for a very long time. Devi Shetty, his name is, the promoter. Quite a good guy, right? So, there are companies like this that can do well. You have to just look at it. Okay? Have you heard of KIMS? I think all the people in Andhra Pradesh and all the people in Karnataka knows KIMS. Okay? It's a hospital, college also, and they have hospital. They have both. They have college and they have hospital. Okay? What is the P ratio? Slightly overvalued, 48 to 41. Chalo, the little here and there. Okay, guys, little over there is fine. It is not like Titan is called overvalued. This is okay. I would say yes, okay. Debt to equity ratio, okay, fine, no problem. Let's go down. Look at the stock price. It has definitely gone from 1,000 rupees to 1,800 in the last 3 years. This is a 3-year chart because it just came out of the IPO recently. Okay, let's look at the sales. Let's look at the sales from 2016. 512, 567, 664, 918, 1123, 1316, 2124. From 2016, they're growing. 109, 18, 71, bad. Suddenly big. Okay, fine. Last 5 years only we'll look at. 115, 205, 344, 366, 336. Little drop over here. Yeah. You see why the drop happened? Even though the revenue went up, some other income from 2752 became 13. And that is why you see EPS has dropped. And that is why you see this company is not a great company. I would say it's okay. Risk is higher?
Medium.
Yes? Okay, let's look at one more company. Are you guys learning now? See, I'm giving you real life examples. I hope you guys are learning. Yeah? Chalo, stock P is slightly overvalued, 30 to 37. Okay, debt to equity is 0.45. Fine. Stock price, oh la la. From 100 to 700. Oh, 7 times in 5 years. Okay, let's understand more. Okay, last 5 years. 19 COVID, 233139. 518 694 839. EPS has gone from 1 to 18. Okay, and if you look at the return ratio, even in the last 10 years, it has given 37% return. Now, to give you more information about what does Ramkrishna Forgings do, Ramkrishna Forgings are basically companies that make nuts and bolts and different type of casting elements for railway companies and automobile companies. Okay, that is what they do. For all railway and automobile companies, they make all the spare parts. Okay. Now, finally, one more company, Kaplan Point Industries. What is the stock P? 21 and 28. Is it overvalued, undervalued, fairly valued? Tell fast. Undervalued. Okay. What is debt to equity? 0. Superb. Okay. Last 5 years growth, very good. In fact, it has been growing every year. Okay. Let's look at the revenue. Wow. Every year the revenue has been growing. Every single year. Look at this. 232, 60, 329, 395, 442. 117, 215, 251, 308, 377, 461. EPS went from 1 to 60 in the last 10 years. EPS has gone up 60 times or 30 times because it's almost 2 rupees. 30 times in the last 10 years EPS. What will happen to your... Woo? Tell me if this is good or bad now. Tell me if this is good or bad. How do I find this company? How did I find this company? This screener, boss. This screener. Take this screener. Go here, put it here, and you will see all of these companies are here, right? If I just filter by market cap, right, you will see the difference. You will see so many companies. Now, can I say all these companies are good? See, Ramkrishna Forging is here. I've just picked some companies. Can I say all these companies are good? No, Kaplan Point is here. There might be some companies that are bad also, right? Okay, no problem. Let's come back. Okay, come back to the Excel sheet. Are you guys enjoying? How many of you all want this Excel sheet? Will this help you if I give you the Excel sheet at the end of the day? How many of you all want this Excel sheet? Okay. So I'll do one thing. Remind me at the end of the session. I will share this link of this Excel sheet with you guys. Okay. Remind me at the end of the session. I will share the Excel sheet. Cool. Okay. 1 second. One more. This is called now very important, guys. The 5-5 approach. And you guys are very smart now. You guys can tell me the 5-5 approach. What is the first step that we need to look at when we're investing in a stock? Is the sector a good sector? Okay. What are some great sectors in India right now? Infrastructure sector, defense sector, EV sector, green energy sector, IT sector, all good. So if we invest in a company that is in a good sector, okay, won't that be considered good? Won't the stock have a higher chance of doing well, yes or no? But if you invest in a sector that is not trending, like your sugar sector, your textile sector, not moving at all, then what is the point? Correct? Next, what do we do after that? We find the stock and then we check the profit and loss statement. We check the revenue, we check the operating profit margin, we check net profit, we check EPS, and we check if the net profit is growing. Then we go to step 3 where we check reserves and borrowings. We know this, me and you know this. Step 4, we'll go check the promoter holding. Because if the promoter is constantly selling his stake, that means why will I buy? If the promoter only is going to sell his stake, I will not buy. It's a red flag. And step 5, sadly, we don't have time to cover this here, but it is about reports and annual reports. How to read investor presentation and how to read annual reports is step 5. Okay? But sadly, I can't cover that here, but I hope that's okay. Cool? Got it? Okay? Now, what are the 5 elimination strategies? When would I say that the company is bad? Okay? The company is bad when you have uneven year-on-year growth. We saw that, right? The growth is going up and down, up and down. We don't like it. We saw that the debt is more than equity. Debt to equity ratio is bad. So that is not required. Then different tax rate. What if this year I pay 1% tax and next year I pay 40% tax? Would you like it? A lot of companies do this, by the way. They artificially hype up the tax to make it look good. Okay. So that is again really bad. Step 4 is promoter holding going down. And step 5 again is sometimes you have invested in a bad sector or sometimes the CRISIL rating mismatch is also there. Okay. So these are the different problems that are there. Cool. Do you want to take a quick screenshot of this? Take it off right now. It's okay. If you want to take a quick screenshot, this will help you a lot. Okay. I'm not sharing the presentation because that's not allowed. But if you want to take a quick screenshot, you can. Okay. Done. What is CRISIL? CRISIL is like, you all of you have this credit score, Do you guys know credit score? All of you guys know credit score? You have credit cards, you have loan, you have your personal credit score. Similarly, all of the companies have their own credit score. All of their companies have their own credit score and that is called CRISIL rating. Like how I have credit score of 450, 500, 600, 700. CRISIL rating is a rating given to the companies on how well they're managing their loan. Okay, guys, this is the previous slide, by the way. For all the people who want to take this, this is the previous slide. Okay? Fast, I need to move ahead. Okay. By the way, the Excel sheet I will give you that has the screener. You don't need all of this. You are already smart now. Don't depend on this. You guys are very smart. Yeah? Cool? Awesome. Now, coming to entry and exit rule. All of us have questions on this? All of us have questions on entry exit rule? Guys, any questions you have later on, we'll take it at the end of the session. I will answer all the questions. Don't worry about it. Now, entry rule we all understood. What do? We go to a stock. We click on the P ratio and check the past P ratio and see if we're investing at an overvalued position or an undervalued position. Right? We agree to this, me and you? Completely agree to this? Right? But now when do we exit? Right? Should I just stay invested forever or should I exit at some point? Okay. So I'll tell you what I do. You guys can see the screen, right? Yeah, you can see it screen. I'll tell you what I do. Let's say I invested in a multi-bagger stock. Let's say I invested in a company and that's given me 44, 45, let's say 50% it went up in 1 year. Now, do I get overexcited that it went up by 50% and just relax? Because there's a high chance that it can go down again. Agreed? Do you agree to me? So what I do is, every time my stock price goes up to around 40, 50%, I remove 20% of my holdings from that stock. You understood? Every time it goes up by 40, 50%, I remove 20% from that stock. Okay? Now, why do I do this? Now, that is my rule. My rule is 50-20. I wait for the stock to go. If I've invested only 1 lakh rupees in that stock, I wait for it to go from 1 lakh to 1 lakh 50. Once it goes to 1 lakh 50, I remove 20% from 1 lakh 50. How much will that become, guys? If I remove 20% from 1 lakh 50, how much money have I removed? Tell me in the chat. 30,000 rupees. Okay, so I remove that 30,000 rupees. But now what do I do with that 30,000 rupees? Do I go drink, party, have fun, enjoy life? No. I take that money and reinvest it in my other companies. So why do I do this? Am I mad? I should just leave it, right, if it's going up. The reason why I do this, I'll tell you. Let's assume there are two people. There is Shashank and there is, let's say, Rahul. Okay? Both of us invested in the same share. Both of us invested 1 lakh and both of our share went up by 50%. Both of us are sitting at 1.5 lakhs. Now let's assume that Shashank removed 30,000 from that share, right? Shashank removed 30,000 out, but Rahul did not remove anything. Now what if the share price falls tomorrow by 20%? Suddenly from 1,50,000, it fell by 20%. Okay? When it fell by 20%, how much did it fall? It came back to 1.2 lakhs. By 30,000 it falls, it came back to 1.2 lakhs. Right? But now tell me, how much had Rahul invested? How much had Rahul invested? 1 lakh. How much is his current holding now after the fall? 1.2 lakhs. That means his profit is 20,000. Now let's assume Shashank Uduppa. I have already removed 30,000. Now even if the stock price falls by 20%, my actual investment in this company is only 70,000 rupees. 1 lakh I had invested, 30,000 I removed. So now I can relax, chill out, I'll let it fall, let it go down. I have no problem. But Rahul will panic. Rahul will be like, oh my God, it's falling down, my profit will go away, I need to sell right now. But Shashank will not panic. Shashank will stay invested because then the market will turn and will start going up. So the main thing about entry exit rule is, right, when the market is going up and when the stocks are going up, exit some amount. Now you don't have to do 50-20. You don't have to do 50-20. You know what you can do? You can do 25. Let's assume the stock goes up by 20%, you remove 5% out. Now when do you stop removing this money? Once I remove my entire 1 lakh out, I will leave that stock. Because that is a free stock for me. That can compound and go up as much as it wants. Until I remove that investment amount out, I have tension. Once I have removed the investment amount, I will not touch it. Got it? Yes? Are we clear? Okay? Chalo. Let's go to the, this is the Titan PE ratio chart. I was just showing some, this I already showed you. Okay? Are you guys understanding me till now? Because after this, we're going into the most important section, which is the multi-bagger section, which is my favorite section. But till now, are you understanding? Are you guys enjoying it till now? Now